Okay, Tyler. So you and I both have followed the steel industry for just about as long as we follow the oil and gas industry and the energy industry. And U.S. Steel, this is a stock that just it's on a ton of people's radar right now. It's up 32, almost 33% year to date, and more than that. So all of that plus some, because it was actually down. I think it was mid-August where rumors first started coming out. I don't think it was rumors. The company basically put itself up for sale, and there's a lot of interest apparently because we've seen consolidation in the steel industry, particularly like one of your favorites, Cleveland Cliffs, has gone through a lot of vertical integration and acquisition. And the question, should investors be interested in U.S. Steel right now? Is it a buy? Whether somebody else buys it or not, is it a stock to buy? Tyler, are you ready to go through this?
Oh yeah, I'm always good for a good, nice conversation about steel.
Yeah, this is going to be a fun one. Before we get into it, though, just a reminder: our videos are sponsored by the Motley Fool. If you're looking for even more great stock ideas, please check out our special link. Go to fool.com/the smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Please be sure to check out that link. Let's lay the groundwork first of all for the steel industry and kind of where steel companies are. It's a very cyclical industry. It can be terrible multiple years, and then demand and pricing get better, and these steel companies can hit a run and become incredibly profitable and incredibly cash generative. And then just as quickly as the market turned positive, it can turn south again. So where are we in the steel cycle, and where does U.S. Steel kind of fit?
As the case with any cyclical industry, there's more than one cycle, right? There's for example, with United States Steel, actually, there's only two left now. United States Steel and Cleveland Cliffs, the only blast furnace steelmakers in the United States left.
And caveat, Nucor is the largest producer of steel, but they use their electric arc furnaces. So they use a different process. So that's the caveat. There's basically three big steel makers, like the largest three, but the two that are the classic blast furnace are Cleveland Cliffs and U.S. Steel.
Yeah, after a long consolidation, they're the only two remaining. And, a lot of what they do is they're big automotive suppliers. So you get a lot of cyclicality related to how much automotive manufacturing you have going on. They're very dependent on the construction site. Sometimes they move differently. Another kind of that's been a nice, we'll call it a couple year tailwind, probably, it's been 6-7 years now, is there's been even further back, because even during the Obama administration, we started to see a lot of targeted tariffs on Chinese steel. Yeah, so we had a lot of dumping, so we had a lot of cheap prices. Nobody was really making a lot of money. So we started seeing some targeted tariffs under the Obama administration. Trump administration put in a little bit more of a kind of a blanket tariff on imports. And then the Biden administration has more or less continued this. And it's been with that, you toss in a little bit of, kind of the global decoupling. We're seeing a lot of construction in the United States to kind of basically backfill some of the things that we used to get from globalization. So you have some tailwinds kind of pushing the steel industry favorably. Unfortunately, the war in Russia and Ukraine has had a significant impact on steel prices because those were two former major producers, and just a lot of other things that are going on that have been favorable to steel prices and to steel production in the United States domestically for a few years now. And it's really reflected in what we've seen from these companies in terms of profitability.
Tyler, I'm going to pull up a screen real quick just to kind of illustrate what we're talking about. This goes back 5 years ago. So this goes back to before the pandemic, 2019, and then 2020 went through the pandemic. And you can see, and this is free cash flows for, I've got U.S. Steel, it's the purple, Nucor, again, the big boy in the industry, and then Cleveland Cliffs, and then Steel Dynamics, which is one we'll talk about a little bit more that I like a lot. And you see, again, this is the impact of the cycle, and it's hit each of these companies a little bit different, but generally their free cash flows have been absolutely soaring. I'm going to put an operating cash flow.
And what's even more surprising is, like you said, there's been these huge gains in terms of profitability. And that's why, even though we've seen a huge increase in stock price, let's just use U.S. Steel for an example. You mentioned at the top how much it's up this year alone. But yet right now it has a trailing PE ratio of 6, which basically means even after that huge gain, it shows you how much of a bumper profit we've had with these companies recently. And so you have that, like I said, we have these tailwinds going on, and you've also got this consolidation wave that's been going on for quite some time. Cleveland Cliffs, formerly an iron ore producer, acquired 2 steel makers. They've acquired a steel scrap recycling company. they've been a major consolidator in the industry. U.S. Steel has been consolidating some of the other smaller blast furnaces and has also been spending rather significantly on some new investments in
Well, they've
electric arc
started moving
furnaces, much
into
like what
EAF.
Nucor
Right,
uses.
right.
And so with all of this, and then on top of that, there was the recent announcement that Cleveland-Cliffs made, I think it was an unsolicited bid for U.S. Steel. The idea being like there is a huge appetite to consolidate this industry because there were so many other players. It was a hamper of profitability locally, and with something that's about making really big factories and being really efficient, sometimes being really large helps. And so you kind of toss all that together and you have what has been one of the best runs for steel producers in the United States recently, specifically United States Steel. And I think they've been getting the most attention, mostly because they're an acquisition target. Cleveland-Cliffs announced it, but then it's been a little bit of like that, boardroom drama where the U.S. Steel says, well, we're not selling to those guys. We're going to take some bids from other people. Private equity put in a bid, but then they dropped the bid. You hear ArcelorMittal, which is one of the European largest steel producers, they're considered flirting with a bid. So it's been a lot of drama, but at the same time, there's a lot going on in the steel industry right now, despite it being a rather sleepy one.
It usually is, and we're still on the generally healthy side of the cycle. Steel prices are still relatively elevated, and still a little bit of the impacts are coming out of the pandemic, right? Because China shut down so much of its own economy. That acted almost like a tariff in a way, because it did certainly pull back on their production. We've seen the impacts of the slowing of the Chinese economy more broadly, because internal investment in infrastructure has been a massive driver for the past 25 years of China's economy. And what the country essentially did is use a lot of their internal production of steel, their production of steel internally, but then they subsidized the stuff that then they would dump into like the U.S. and Europe and other markets to kind of support that internal industry. And that's been harder to do in their current economic environment. And you put all that together, Tyler. Again, you said you make the case looking backwards that a U.S. Steel still looks pretty cheap, but then you look forward, you think about it as a standalone company, not as an acquisition. Are you buying U.S. Steel?
People that are looking at this need to keep that context in mind, right? Like very rarely do you just want to buy a company on the bet that it's going to get acquired, right? Like for number one, the stock is more or less priced at the acquisition target. So you're not, buying any, gain.
Round figure U.S. Steel's market cap right now is about $7.4 billion. So that's a rounding errors from Cleveland-Cliffs' reported offer.
Exactly. For years, U.S. Steel was kind of the bloated, unproductive, low margin, couldn't get things done relative to the rest of the industry. Even some of the other blast furnace steel producers that were okay relative to what U.S. Steel did. But in recent years, you're seeing an increase in profitability. The returns are improving. I think a lot of people would like to see more cash flow, but they've been making these significant investments in a electric arc mill to diversify its production methods and hopefully kind of remove some of that cyclical aspect to it. And that's going to start winding down with all of that, most of that spend actually already complete. And so there's part that says like, okay, well, this has gotten better. But what I have not been able to effectively do when looking at the company is isolating whether these improved returns and kind of the strategic moves that they have been making has been the reason that we're seeing increased profitability and improved metrics that you'd want to see from steel producers, or if it's just been we're riding a high of a good steel market right now, and if the steel market kind of goes down again, then we're not going to look great.
The bottom line is, and to sum that up, is it improved operations, or is it just the timing of the cycle, right? And we don't know, we can't tell that, because it is the part of the cycle where if you're a steelmaker, you make money. And that is I think that is a real concern. I think when you're looking at this industry and you're looking to invest, you have to find the ones that have a history of being really good operators across the cycle. And as much as U.S. Steel probably has made some improvements, we just don't know what's going to happen when the cycle turns, because eventually it's going to turn. For the past, I think you could say 30 years at this point, probably more like 40 years, every time the steel cycle has turned, this is a company that's gone from generating cash to absolutely incinerating cash, right? You got to keep running those blast furnaces, and that high fixed operating cost is so value destructive when the cycle does turn. And I'm not convinced that that's changed. There's no evidence that it's changed. And I think US Steel is still one of those companies, until there's evidence that that's changed, it's not one to buy. For me, I would be far more interested in Steel Dynamics. Starting from a valuation perspective, again, it trades for a similar backwards valuation, trailing 12-month valuation. You look at forward earnings estimates, trades for about 7.2, 7.3 times forward earnings estimate. It's the cheapest of all of these large steel makers, and they, like Nucor, their operations is built around the electric arc furnaces. And where that's beneficial is when the cycle turns, you have far more variable costs. You can bring them down very quickly. And until US Steel demonstrates that they can do that, I would be far more likely to buy a Steel Dynamics that's proven that it can do that. It's been a big, huge winner too. This is a stock that's absolutely beat the market, beat the pants off the market over the long term. So I would look at Steel Dynamics before I looked at US Steel.